So over my 10 plus years of running Stocktrades.ca and my 16 plus years of being a self-directed investor, I've managed to narrow down some of the worst errors that retail investors make that ultimately cost them money. And one of the most difficult things about these errors that I'm going to go over in this video, which are highly likely costing you overall returns in your portfolio, is they are mostly on a psychological basis, and sometimes we don't even realize we're making these mistakes. So I decided to do this video because it can kind of tune you in to some of the mistakes that could even be on a subconscious level that you're making with your portfolio that could be costing you money. So you're going to want to stick around for the entire video because I actually feel the final point in this video is probably one of the most important. My name is Dan Kent. I am the co-founder of Stocktrades.ca, one of the co-hosts of the Canadian Investor Podcast, and I'm going to dive deep into 3 psychological errors you might not even realize you're making with your portfolio. And I've backed up every single one of these errors with back-tested studies and actual research. It is going to be one of the best and most important videos you've watched if you're trying to squeak out that little bit of an extra return and ultimately grow your portfolio that much faster. And speaking of growing your portfolio, I've got a link in the description for 3 of my favorite stocks for 2025, but let's dive right into it. So mistake number 1, and this is actually called the endowment effect. And it is a mistake that a lot of investors make, not only on the investment side of things, but just in life in general. And this is a tendency for us to overvalue something simply because we own it. And if we ignore the investing side of things right now and we think of just something as simple as the sale of a vehicle, if we own a vehicle, we might be biased towards the fact that it's probably worth a little less than what we think we could get for it in a sale. The same can be said for a lot of stocks. A lot of people will kind of take a more unbiased approach to equities that they don't own. However, with equities that they do own, they still take a biased approach, but it's more so along the lines that they tend to think that stocks that they own are likely better than they actually are. Now, this is not the case for every single one of your holdings. I'm sure you own a ton of high quality stocks, high quality ETFs, but we tend to put a lot more positive emphasis on poor holdings than if we were to have an outside view at it, not own the stock, and we would probably be a lot more critical of it. But because we've committed that time in terms of research, because we've committed that, financial investment in terms of money, we tend to lean towards a more positive bias, which ultimately could actually end up impacting our overall investment returns because we are now somehow emotionally attached to those holdings. This, I would argue, is one of the biggest mistakes that I have made throughout my investing career and is probably one of the bigger mistakes I've made today. I've held on to a lot of holdings that I have somewhat known I should have sold. However, the hours of dedicated research, the money that I'm now sitting on a loss at, that creeps into your head. You don't want to give up on that investment, even though you know you should. And the quicker you can take a unbiased approach to not only holdings that you don't own, but holdings that you do own, it will allow you to make a lot better buy and sell decisions with your overall portfolio, which will in the end improve your returns. So the one interesting study from this is back in 2023, BMO did a study that highlighted that 41% of retail investors struggled to sell an investment, a losing investment that they've held for more than 2 years, even if it was drastically underperforming the market. And in addition to this, most retail investors from that study would know that the investment has underperformed and would likely be better allocated elsewhere in terms of returns. However, they're too attached to that particular holding, or they're too focused on the loss. They're afraid of selling that equity and then it rebounds after they've sold it. This is a very, very hard mental hurdle to get over, but once you do, it will ultimately help your portfolio. One of the other things I see all the time in terms of attachment to holdings is investors get attached to past performance, and they kind of believe that, they've owned a stock for the last 10 years, 15 years, 20 years. It's done well for them over that time period, but over the last 3-4 years, the fundamentals have deteriorated. The stock is not performing that well right now, and ultimately performance is really lagging. The thesis has 100% changed, but they feel an attachment to it because it's done so well for them in the past. They have a hard time letting go. So back in 2023, FP Canada, which is a financial planning association, they did a study and they found that nearly 50% of retail investors hold on to underperforming investments because of an emotional attachment. Whether that emotional attachment was previous returns, whether they inherited those stocks from maybe family members who had passed away or who had owned them for a very long time, there's an emotional connection to that stock. And the quicker you can completely eliminate this thought process, the better your decisions will be in your portfolio and the more you can potentially earn. Now, again, this is a very difficult mistake to conquer. I make it all the time, so just know that you're not alone if you are doing this. So actually, just a quick break from the video. If you're liking it, head down below, like the video, subscribe to the channel, and drop a comment and let me know what mistake you actually end up making the most. But the next one we're going to be going over is probably one of the most common ones I've seen from retail investors, and that is anchoring bias. So anchoring bias is effectively relying way too much on a previous price point or even something like an adjusted cost basis when it comes to making your investment decisions. Now, a lot of this has to do with also the integration of something like sunk cost fallacy, where we feel we've invested a ton of time into something, a bunch of money into something, so we're going to wait until we break even. We don't want to sell at a loss, things like that. And another element that retail investors anchor to is something like a 52-week high. Maybe a stock is trading at its 52-week low. They look at the 52-week high, and that's kind of their basis. That's where they feel the stock could get back to. But there's plenty of examples of many stocks that never really returned to 52-week highs. And there's also that element of analyst price targets, which a lot of people anchor to, and they are effectively useless. I believe there was a study done, I believe this was probably 10 years ago now. They did a study on analyst price targets, and they figured out that only around 30% of them were actually accurate over the next 12 to 18 months, which is usually when these analysts will issue their targets. 30%. So you can pretty much attribute almost all of those situations where the analysts were right to luck. But I mean, a lot of people anchor to those price targets. They buy a stock because they see a high price target, and they get stuck in their head that that price target is going to be hit when there is absolutely no guarantee. Now, anchoring in terms of adjusted cost basis is also something that a lot of people do. So the Ontario Securities Commission, back in 2022, I believe it was, they did a study. They found that 64% of retail investors use their original purchase price as a benchmark for decision making. And the other thing that I'll add to this, there's not any sort of study on this, it's more anecdotal. In my situation is I see plenty of people using their adjusted cost basis to make decisions. So if a stock is trading below their ACB, they will tend to buy more of it because it lowers that adjusted cost basis. Whereas if the stock is trading above that, they might not want to add at this point in time because there's an element of buy low, sell high that investors get absolutely obsessed with, to the point where they constantly want to be decreasing the amount of money they pay for their shares. However, I will tell you right now, most of the long-term winners in my portfolio that I have owned, I have consistently bought them and increased my adjusted cost basis. I mean, just off the top of my head, I could think of Constellation Software. I originally bought that company around $1,500 a share, I believe. It's done nothing but go up. And what have I done? I've routinely added to it over years and not obsessed with getting my adjusted cost basis lower. The buy low, sell high type situation is going to cause you to anchor yourself to always wanting to lower that adjusted cost basis. And ultimately, you're just going to end up averaging into poor investments. This is not always the case. I want to clarify that. But in a lot of situations, it is the case. I mean, I can look no further to a company like BCE, which a lot of investors were dollar cost averaging into when it fell from that $70 range down to the $60 range. And then it continued to fall down to the $50 range, down to the $40 range, mid $30 range. I mean, where does it end, right? So back in 2021, TD Wealth, they ran a study among their clients, I imagine this would be, and they found that 70% of clients showed some sort of anchoring bias to stocks inside their portfolio that had very poor performance. They had some sort of fixation on a previous price point. Maybe their adjusted cost base is trying to get that lower, and ultimately all that ends up doing is costing you returns. So the third and final psychological error I will go over is the disposition effect. And this is something that I can guarantee you, if you haven't done this before, you have ice in your veins. It is holding on to losers too long and selling winners way too early. I can almost guarantee that everybody, myself included, numerous times actually, has sold a winning stock too early based on some sort of fixated price number and not necessarily fundamentals, and they've held on to a losing stock way too long based on the exact same thing. The fundamentals have deteriorated, but instead they don't want to sell the stock in the red. They kind of ignore the investment thesis that has changed. The stock is fundamentally weaker now than it was when they bought it at the higher price point. It might never see that price point again, but they hold on to it way too long. And in the event of selling your winners too early, they will buy a particular amount of stock, let's say $5,000 of it. The stock will go on quite a run. It will increase 100%, backed by solid fundamentals, earnings growth, revenue growth, increasing returns on capital, things like that. They will be satisfied with a 100% gain and they'll sell that stock. And 10 years down the line, that stock is 10x, 15x, 20x higher. This happens all the time. I mean, if we go back to a situation like I had mentioned with Constellation Software, I easily could have bought that stock at $1,500 a share and sold it at $2,500 a share and been absolutely happy with my profits. However, we fast forward to now, the stock's trading at over $5,000 a share. So I actually think that selling too early is actually more impactful than holding too long. But holding too long is definitely something that impacts investors a lot. The only reasoning behind why I think selling too early actually impacts you more is if you invest $5,000 into a particular company and it goes down 50% and never really recovers, you're in the negative by $2,500. If you buy a stock and take profits at say 100% and the stock goes 5x from there, you've lost tens of thousands of dollars in potential gains. So I do believe the selling too early is the bigger impact, but the sunk cost fallacy, the refusal to sell a stock in the red, is also a big detriment to your overall portfolio. And this is actually backed by studies. So there was a study in 2022 by Behavioral Economics in Action that actually highlighted that Canadian investors were 40% more likely to sell a stock that is in the green rather than one that is in the red. Let's just say, in the simplest terms possible, Canadians are highly likely to book profits rather than take losses. And there's another actual very, very interesting statistic from the Royal Bank of Canada. So they stated back in 2021 that 38% of investors regretted selling a stock that went higher. However, only 12% had regret from holding on to a loser for too long. This is naturally because we fear loss much more than we strive for gains. If we have to sell that loser and book that large loss, that is a big mental hurdle for a lot of us to get over. So we're not as upset holding on to it for longer periods of time, making it an unrealized loss, even though deep down we know that it's highly unlikely for that to ever be a strong investment. And the final statistic here I'll go over is the University of Toronto did a study that highlights that retail investors are 1.5 times more likely to sell a winner than cut a loser, even though ultimately cutting the losers are what will help your portfolio more over the long term. There's a very popular saying in the investment industry when it comes to this. You don't cut your flowers and water your weeds. You do the exact opposite. However, this is, in terms of sunk cost fallacy and investors' refusals to take losses, to accept the fact they made a poor investment and move on and buy something else. This is why this error creeps into the vast majority of investors' portfolios I've seen. And this is also one that I have completely eliminated from my investment mentality. If the thesis has changed on a company I own, I don't care if I'm down 50%, 75%, 90%, I sell it and I move on. And I will tell you right now, this has only improved my portfolio's returns over the years. So everybody, that is it for the video. Let me know what is the most common mistake out of these three you make. If you make all three, if you make one or two, what ones you've improved on, let me know down in the comments. And also let me know what types of videos you want to see next. I did a video on the TFSA mistakes that investors typically make, and I will put a link at the top of this video for that. And a lot of people requested more videos like this because ultimately it helps them become better investors. And I need to hear from you in the comments if you want to see more videos like this. And as always, head down below, grab that report on 3 of my favorite opportunities over the next while here, and we'll see you next time for more great investment content.